Okay, let's start. So what I'm going to be doing is we are going to do a full 100% revision, 100% revision of the entire FM syllabus. Okay. So I will, remember it's a revision, not the content class. So don't ask me silly doubts. Don't come and ask me now, sir, what is the meaning of NPV, sir? What is the meaning of cost of capital? This is not a content class. This is a revision class. So I will be going over the content. I will be touching upon the main areas in the FM syllabus, what you have to keep in mind. So what I need you all to do is while I am teaching, okay, while I'm revising, you have to follow my explanation. So I will give you a little bit of time to write. But while we are revising, you should not be writing. You should be listening. Okay, so listen to my explanation. So when we are covering the areas, okay, if there is a gap, try to identify if there is a gap in your knowledge. For example, when we are discussing investment appraisal, when I'm talking about NPV versus IRR, there are certain points. So when I'm revising that, if you feel like, this is something new, no, I don't remember it. What is that? A gap in your knowledge. So this revision class is for you to identify these gaps where I weak in so that you can, go back and look at that little bit in detail. Okay. So, and one more thing, while I'm doing the revision, I need you all to be responsive. Okay, so sir, I will be, doing the revision on my own, yes. But here and there, I'll be asking certain questions. You all have to reply. So let me just quickly go ahead and give you all the unmute option. Okay, so I'll give you all the ability to unmute also. If you all want to unmute and speak, you all will be able to unmute and speak. Okay, yes. Okay, so now let's start. So before I actually start, can I have a confirmation? Everyone is ready? All of you all are ready? Yes. Okay. So we are going to be doing the revision in the order which we covered the syllabus. So for the Jan batch, we started off with investment appraisal. So the revision is going to continue in that same order. So the first area in investment appraisal, what did we look at? First area was introduction. Introduction to investment appraisal. Okay. So under the introduction to investment appraisal, what did we look at? First thing which we looked at was discounting. We looked at discounting. Present values. Basically, present values, we looked at the present value formula. Okay. We looked at the present value formula. Future value equals present value into 1 plus r to the power of n. Next, we looked at what? Relevant cash flows. We looked at relevant cash flows. And next, we looked at cash versus profit. Okay. So under relevant cash flows, what is the definition of relevant cash flows? Remember, in whatever investment appraisal calculation which you are doing, always what type of cash flows do you have to take? You have to always take relevant cash flows. So what are relevant cash flows? What are not relevant cash flows? Let's quickly go through the differences. Okay. Relevant and not relevant. Okay. So relevant cash flows are what? Those are cash items. Not relevant are non-cash items. Example, depreciation, non-cash, therefore not relevant. So I feel like you all are a little bit lacking in the basics. So in many of the students, the mock exams which you all did, you all are attempting the NPV questions just based on whatever information which they are giving. In the question, they are giving depreciation. In the question, they are giving head office overheads. In the question, they are giving different expenses. You all are just including every single little thing in the NPV calculation. No, you are only supposed to include relevant cash flow. So what are the features of relevant cash flows? One, they are cash. What's the next one? They are future figures. And non-relevant cash flows are sunk costs. Next, they have to be incremental. What mental? Incremental, which is something new. These are what? General costs, sunk costs, committed costs. All of these are not relevant. Okay, keep that in mind. Very simple understanding which you all have to have. Next factor is cash versus profit. What is the difference between cash and profit? So again, I'm not going to explain this. Okay, so you have to know the differences. What are the differences? You cannot spend profits. Profits are subjective. Profits can be manipulated. These are the differences. In FM, cash is king. So this was the introduction which we did. Then the next thing which we covered, what was it? Basic investment appraisal. Basic investment appraisal. So under basic investment appraisal, we learned the major methods. Okay. So we looked at two different categories. We looked at two different categories. First category is what? Cash flow based investment appraisal methods. We can say discounted yeah, cash flow, and these are the other methods. Discounted cash flow. So under discounted cash flow methods, what you have? You have NPV and you have IRR. Under other methods, you have ROCE and you have payback period. Okay. So let's quickly go through each one of them. Okay. So let's start off with NPV. Let's start off with NPV, net present value. Okay. So you have to know the NPV rule first. You have to know the NPV rule. What is the NPV rule? NPV positive means accept, negative means reject. The decision rule. Next thing which you have to know is what? What are the advantages and disadvantages of NPV? What are the advantages of NPV? We are considering the time value of money. It is a absolute measure. It is based on cash flows. It considers the entire life of the shareholders and it maximizes the wealth of the shareholders. These are the advantages of NPV. What are the disadvantages? It is difficult to explain. You need to calculate the cost of capital. Okay, it is a absolute measure. It's not a relative. Difficult to compare projects of different sizes. These are the disadvantages. So all of these should be there in your mind. Why? Because you can get theoretical questions. They can ask you to explain NPV and IRR. So in the previous mock exam, there was a question, explain investment appraisal methods. Answers were very weak. You all have to describe. NPV is a absolute measure. It shows the increase in the shareholder wealth. If NPV is positive, accept. If NPV is negative, reject. It considers the time value of money. All of these features, characteristics, advantages, disadvantages should be there in your head. Very simple, small list. Keep it in your head. Second thing, IRR, internal rate of return. The rate at which IRR becomes zero. What is the decision rule? IRR is greater than the capital. Correct. IRR is less than the cost of capital. Reject. Okay. Next, you need to know what are the advantages and disadvantages of IRR. Okay. What are the advantages of IRR? But it considers the time value of money. It looks at the entire life of the project. It uses cash flows. It is a relative measure. Advantages. Okay. Disadvantages. It is not a absolute measure. If you use interpolation, it's just an estimate, not an accurate figure. It is complicated to explain. It is complicated to calculate. If you have non-conventional cash flows, you can get maybe zero, maybe one, maybe two IRRs. Disadvantages. Okay, fine. And the final disadvantage, we'll look at that later. Okay. So you have to remember one more thing. IRR can be calculated in two ways. One is you can estimate the IRR using interpolation, using the formula, or else you can calculate it using Excel. So which is the most accurate answer? Using the Excel. Next, other methods. ROCE, return on capital employed, or ARR, accounting rate of return. So this can be calculated in two ways. This can be calculated in two ways. Okay. So you can calculate it based on what? What are the two ways which you can calculate ROC? One way or two way? How many ways are there? Average profit over average investment. Okay. Fine. So ROC, how do you calculate average profit over average annual investment? Sorry, average investment, or you can take average profit over capital employed, investment, whatever. Okay. So ROC, what is the decision rule? If your project's ROC is greater than the target ROC, accept. Project ROC is lower than the target, reject. Simple as that. Okay. So what is the advantages, disadvantages? It is a advantages, quick calculation. It is a relative measure. It gives a percentage, easy to understand, looks at the entire life of the project. Disadvantages, we are not taking into account the time value of money. Okay, we are not taking into account cash flows. We are using monada, we are using profits. It is not an absolute measure. There is no proper investment signal. Disadvantages. This should be there in your head. Okay. So yeah, ROCE greater than target set. Final method, payback period. What is payback period? It is measuring how long it is taking for you to recover the initial investment. That is payback period. So what is the payback period rule? If your company's payback period, if your company's payback period is less than the target, except if your payback period is greater than the target, you will reject. That is the decision rule. What are the advantages, disadvantages? Advantages, easy to understand. Okay. What it can be used when there is liquidity problems. It can be used in capital rationing situations. It is using cash flows. Disadvantages, it is ignoring the returns after the life of the after the payback period. It is subject. Sorry, there is no investment signal. It is ignoring what time value of money. All of these are disadvantages. Next. Next, what are we going to look at? What is the next topic? Next topic which we are going to look at is Monada. NPV versus IRR. So we can have that here. NPV versus IRR. Who is superior? Which is the better method? NPV or IRR? Which is better? NPV is the superior method. But you can't just say NPV, you have to know the reasons. Why is NPV greater than IRR? There are only two reasons for this. Two things which you have to remember, keep in your head. You should be able to explain these two things in the exam. Why is NPV greater? First reason is the reinvestment. What is the second reason? Guys, what is the second reason? Quick, respond. First is reinvestment, second one, non-conventional. Okay. So in a situation, you should be able to explain this in your answer. What is reinvestment assumption under IRR? When we are doing the IRR calculation, we are assuming that the cash flows are reinvested at the IRR rate, not the cost of capital rate. Is this a correct assumption? No, this is a wrong assumption which we are making. The company will never be able to, Monada, we will never be able to reinvest at the IRR rate. Impossible. Therefore, it is a wrong assumption which we are making, which is leading to the wrong value. First one. Second one, non-conventional cash flows. When there is a series of cash outflows followed by a series of cash inflows, when there when there is non-conventional cash flows, if you use the IRR, if you use the IRR, what will happen? You will get sometimes one IRR, sometimes you will get two IRR, sometimes you can get zero IRR also. Therefore, you will not be able to make the decision. So, how many reasons are there? Why NPV is superior? Two reasons: reinvestment assumption, non-conventional cash flows situations. Remember this. Next thing which we are going to look at, reinvestment assumption again. Okay. So reinvestment assumption is that. So let's assume IRR is 15%. Cost of capital is 10%. Okay. So when we are doing the IRR calculation, we are assuming whatever cash flows which we are getting. For example, year one cash flow is $10,000. So when we are doing the calculation, NPV IRR calculation, we will not be withdrawing this cash inflow. So in the project, you are investing in a project, you are getting a cash inflow of $1,000. You won't take that $1,000 and put it in your pocket. You will invest it again inside the project. You will reinvest that $1,000. So therefore, if you reinvest it, you will get a return. But realistically, if you reinvest this $1,000, return will be somewhere around your cost of capital. But in IRR, we are assuming that the reinvestment will be at the IRR rate of 15%. So there is an extra 5% we are adding for the return, which is false. Okay, Amna? Next. Advanced NPV calculation. Advanced NPV calculation. So under the advanced NPV calculation, first thing which you have to remember is the what? Rate adjustment. The rate adjustment. For that, we are using the formula 1 plus I equals 1 plus R into 1 plus H. Fisher's formula. Okay. So you have to remember. What do you have to remember? If you are using the inflated cash flows, you have to use the inflated rate. If you are using the not inflated cash flows, you have to use the not inflated rate. In other words, inflated cash flows. What are inflated cash flows? What is another name for inflated cash flows? Guys, make it quick. What is another name for inflated cash flows? Money cash flows, correct. Money cash flows. Oh, nominal cash flows. If you are using inflated cash flows, if you are using money cash flows, you have to use what rate? Money rate, not inflated rate, nominal rate. If we are using not inflated cash flows, so we call it real cash flows, you have to use what rate? Not inflated rate, real rate. One more important exam point which I'm teaching you all. Many of you all are making this mistake. In a question, listen carefully. If they have given the general inflation, if they have given the general inflation, only general inflation rate. They have given only one inflation rate. They have given only one inflation rate, general inflation rate, let's say 8%. So if they have given one inflation rate, general inflation rate, you can use either method. You can inflate the cash flows and use the money method, or without inflating the cash flows using the real rate, you can do the NPV calculation, doesn't matter. Come on. If they are given one inflation rate, whatever the hell you want, you can do it. But in majority of the NPV questions, guys, you will be getting two different inflation rates. One is general inflation rate. What is the second inflation rate which you all will be getting? You will be getting fifth inflation rate. So, Dekama Dunnama, what is this one? What should you do? Should you use the money method or the real method? Let's say specific inflation they have given for what? Fixed cost 5%, whatever, variable cost 3%, sales, whatever they have given, different specific inflation. So what should you do? Should you use the money method or should you use the real method? Guys, remember, always follow the money method. Always follow the money method. Because why? If you try to use the real method, working is different. Therefore, you will get confused. Can you use real method? You can. But should you use it or don't use? Always follow the money method. Ahnaf, don't ask stupid questions. 8% is the general inflation rate. Don't make me angry, Ahnaf. You have 1 week for your exam. Don't ask these type of questions, okay? I'm getting pressure now. Okay, fine. Next adjustment which you have to make, what is the adjustment? Tax adjustment and tax saving adjustment. Tax adjustment and tax saving adjustment. So tax payment and tax saving. So tax saving you will be getting for tax allowable depreciation. So on tax allowable depreciation, you will be getting a tax saving. So in this tax payment area, be very careful about a couple of things. Okay, y'all, when I'm telling this stuff, y'all might be thinking, sir is mentioning basic stuff, very simple. No, why is sir think, does sir think we are stupid? Yes, I think y'all are stupid. I think y'all are stupid. That's why I'm telling these small things. Because no matter how many times I'm telling, again and again, you all go and make the same mistake. That's why I like to repeat. So tax payment, you have to be very careful. One thing about the tax rate. In majority of your questions, tax rate will be 30%. Does that mean in the exam also they'll give 30% tax rate? No, it can be 25%. It can be 40%. We don't know. So don't just assume always tax rate is 30%. Okay. It can be 25, it can be 30, whatever. Read carefully. Next thing, timing of the tax payment. Sometimes tax will be paid 1 year in arrears. That means 1 year in arrears means year one tax payment you will make it in year two. That is what arrears means. Sometimes tax is paid in the same year. Year one's tax payment will be paid in year one itself. This is arrears. This is paid in the same year. Next thing is tax is paid in advance. Year one's tax will be paid in year zero, 1 year prior. So it could be anything. It could be in arrears, it could be in the same year, it could be in advance. Anyway, they can test it. But you have to be very careful with the timing. Don't go and put it somewhere else. Read carefully what they are saying. And finally, be very careful with the with the depreciation calculation. So in all of the questions, it won't be reducing balance. Sometimes it can be straight line also. It's possible. So be very careful there also. Okay. So these adjustments, be very careful with it. In the tax adjustment, you have to be very careful. Next adjustment, what is the next one? Working capital adjustment. working capital. Guys, give me 1 minute. Give me 1 minute. Yes, sorry. Okay. So working capital adjustment. So again, couple of things to remember in the working capital adjustments. Be very careful. One thing, remember guys, in your working capital adjustment, always working capital should be invested 1 year prior. Let's say, let's take an example. Year one, working capital requirement. Year one, $10,000. Year two, 15,000. Year three, 8,000. This is the working capital requirements. Either listen carefully. So let me show you how it will look like in the NPV calculation. Year 0, year 1, year 2, year 3, year 4. So in your pro forma, in your NPV format, how will these cash flows look like? So always you have to invest working capital 1 year in advance. So year one's working capital will be invested when year one's working capital will be invested in year 0. So in year one, if we need $10,000 to be there for working capital purpose, we have to invest that $10,000 in year 0 itself. So we are investing $10,000. Right? We are investing $10,000. So you have to remember this working capital is like a cup. It's like a glass which we are keeping. This is the working capital cup or working capital glass. So in year 0, what did we do? We filled this glass with $10,000. At the end of year 0, we put $10,000. So during year 1, what is happening? We are using this $10,000. We are taking from this cup to pay for the supplier, to buy inventory, to pay salaries, to pay wages, to pay water bill. We are taking the money slowly, slowly, slowly. We are taking. But remember, whatever the money which we are taking from this cup, if we take the money out, always remember using the business cash, always this cup will be filled again. So at the end of year one, how much will be there in this cup? $10,000. End of year one, how much is there in this cup? $10,000. What is the requirement for year two? 15,000. How much extra do we have to add? $5,000. So only that extra amount we will invest for working capital purpose. We will put it out of our pocket. Okay, we will put it out of our pocket. So how much is that? $5,000. Okay. Year three, what is the requirement? 8,000. Okay. So at the end of year one, what is happening? We are keeping at the end of year one in our cup, how much will be there? $15,000 will be there. But do we need all of these $15,000? No, we don't need all of these $15,000. We only need 8,000. How much extra is there? 7,000 extra is there. That is a what? That is an outflow. Sorry, that's an inflow cost. That's a inflow. So we are taking $7,000 out. Balance is $8,000. So at the end of the project, remember always working capital will be taken out of the business. So you will have only $8,000. The owner will take that $8,000 and go home. Always, whatever amount is invested, you will recover that working capital amount. So this is how it will look in the pro forma. So Osara, a balancing charge means we are making a profit on the sale. Therefore, we have to pay tax on that. So we will be deducting it. A balancing allowance means we are selling it at a loss. Therefore, we will be getting some sort of tax benefit. So it will be an inflow. Okay. So balancing charge is an outflow. Balancing allowance is an inflow. Okay, Osara. So if we invested working capital at the end of year, only in year 0, do we recover that? So you're asking if we are investing working capital in year 0, and here again we are not investing year 1, year 2, year 1 and year 2, what will happen in year 3? You will always recover it. So Ahna, when you are Doing the question, when I'm teaching working capital, I mentioned, right? What is the assumption in working capital? Always that money, whatever investment will be recovered, no matter what happens. So I told you all while teaching. So if you can't remember that, that is your problem. You should have looked at your notes. Okay, it's always recovered, no matter what. Do we need to show the working capital working separately? Yes. If they have not given the working capital requirement, you have to calculate it separately and show. Yes. Certain times they will show the working, certain times certain times they will give the requirement, certain times they won't. If they have not given it, you have to work it out by yourself. Uh, Next thing which we have to look at, what is it? Asset replacement decisions. Asset replacement decisions. Under that, first thing is lease versus buy. First thing is lease versus buy. What is the next thing? EAC. Next, only these two, no? After that, you have capital rationing. That is something separate. Yes. So lease versus buy. Lease versus buy. So what is lease versus buy? What is lease versus buy? Lease versus buy is what? You are comparing what is the NPV if you go for a lease option, what is the NPV if you go for the buy option. So you have to compare the two based on the cash flows which are there, and you have to go for the cheaper option. So what are the cash flows generally which you have to consider? You have to consider the rental cost, you have to consider tax saving, all of that. And next, finally, you have to take the what cost of capital, what rate do you use? You use the KD. Remember, you are going to be using the KD, cost of debt. Next, EAC, equivalent annual cost. EAB, equivalent annual benefit, both are coming under the same thing, same topic. Okay. So EAC, how do you calculate? How do you calculate EAC? NPV over the annuity factor. So what does it give you? Each year, what is the cost? Each year, what is the cost? What is the cost each year? You are going to calculate the NPV of replacing the asset. Okay, if we replace the asset every 2 years, what is the NPV? If we replace every 5 years, what is the NPV? If we replace every 10 years, what is the NPV? And then you are going to calculate per year what is the equivalent cost. And you are going to go for the lowest option. Okay, or cheapest option. Next topic is what? Capital rationing. Capital rationing. So, what is capital rationing? Capital rationing is a situation where a company does not have enough money, enough capital, enough finance to invest in all of the positive NPV project. Okay, that is capital rationing. So, there are two types of capital rationing. Hard capital rationing is what? From externally your funds are being limited due to external reasons out of your control, outside the company. For example, economic conditions of the country, industry, wide, factors, there are problems, a poor track record, company has a poor track record. Those are reasons. Soft capital rationing is what? The company itself is limiting themselves. One reason could be limited skills. Okay. Next is the efficiency. all of that. Give me 1 minute. Okay. So those are the reasons for capital rationing. Okay. So next we are going to look at the different periods of capital rationing. Capital rationing. Same continuation, but periods of capital rationing. So you have single period capital rationing and you have multiple period capital rationing, multi-period capital rationing. So single period capital rationing occurs when you don't have funds for one period, this period only. Multi-period is when for many periods you don't have capital. Okay. So in your FM syllabus, we are going to look at only what type of how we are going to deal with what type of capital rationing situation, single period or multi-period capital rationing. Only single period capital rationing. Okay, only single period. So under single period capital rationing, we are going to look at a few things. First one is divisible projects. How do we deal with divisible projects? Profitability. How do you calculate profitability index? NPV divided by the investment. Next is indivisible projects. How do you deal with indivisible projects? Trial and error. Correct. And next, mutually exclusive projects. How do you deal with mutually exclusive projects? Yeah. If it's mutually exclusive projects, what do you do? Better NPV? No, that's also trial and error actually. That's also trial and error. Depending if it's divisible or indivisible, generally it will be indivisible project. So you will go for trial and error. If it's mutually exclusive, divisible, profitability index. If it's mutually exclusive, indivisible, trial and error. But generally, mutually exclusive, they will give indivisible. Therefore, we will use the trial and error method. Next, we are going to look at risk and uncertainty in investment appraisal. So when there is risk and uncertainty, what are we going to do? First one, first method is what? Sensitivity analysis. So what is sensitivity analysis? Sensitivity analysis looks at, okay, how much should a variable change in order for us to reverse our decision? How do you calculate sensitivity? Sensitivity is what? How do you calculate it? NPV divided by the present value of the variable. Okay, that is sensitivity. Okay. So you have to know what are the advantages and disadvantages. What are the advantages? It's easy to calculate. Okay. You can identify the critical variables. What are the disadvantages? You can only look at one variable at a time. Okay. It does not give a decision rule. All of that. Next method is what? Certainty equivalent approach. So certainty equivalent approach, you don't have numbers. It's technically not there in your FM syllabus, but I've just included it just in case it's tested. So certainty equivalent approach, what are you doing? You are keeping something called a certainty equivalent. And you will, okay, what do you mean by certainty equivalent? The amount which is, 100% you are sure which you are going to receive. That is a certainty equivalent. So you, for each of the cash flows, you will provide a certainty equivalent and you will do the NPV calculation. Next thing, scenario building. Okay. What is scenario building? You will use, computer softwares, different computer softwares in order to create different scenarios. Okay. Where different things might be occurring. Scenario building. Okay. Again, no numbers, just the theory. Next thing, expected values. So using probabilities, you are going to calculate a weighted average. What is that weighted average? You call that weighted average probabilities. Okay, so under that, another small part which is coming, joint probabilities. Joint probabilities. So a little bit complex calculation. So it's a calculation part which I'm not going to explain, but there is something called joint probabilities. Okay, next you have to know what are the advantages and disadvantages of expected values. One is it gives you one number, easy to understand, simple calculation, all of that. Disadvantages, probabilities are subjective. Okay, whatever expected value might not, correspond to any actual outcome. Okay, next, it ignores the risk appetite. Next thing is what? Simulation. So simulation, what is the difference between simulation and scenario building? What is the difference? Technically, there is not much of a difference, but under scenario building, you will be creating a scenario. But in simulation, you are changing variables. That is the only difference. In simulation, what are you doing? You will look at, okay, if you change multiple variables, you are changing variable cost, fixed cost, you are changing economy, you are changing everything, what is going to happen? What is scenario building? You are creating some sort of actual scenario, actual story. That is scenario building. So both are what softwares which you are going to use. Humans cannot do this sort of calculation. Final area is what? Discounted payback. So using the discounted cash flows, you will calculate the payback. So you have to know the advantages and disadvantages. What are the advantages? Easy to calculate, takes into account the time value of money, users, cash flows. Next, disadvantages. You are ignoring the cash flows after the payback period. Okay, that is the disadvantage. Does not look at the entire life of the project. And the final method is what? Using a risk adjusted discount rate. So how to use a risk adjusted discount rate that we have looked at in business finance. So this is your investment appraisal. Okay, 25% of your syllabus. Let me zoom out. Only this much. Only this much. How much? Look at this. So little. This is 25% of your syllabus. Very simple. If you want, take a screenshot. Any questions over here? Any questions from investment appraisal? So let's go for a quick prayer break. For certain students, ask for a quick prayer break. Let's go for a 10 minutes break. So we'll finish one more area and go for your dinner break. So 10 minutes, 7:20. Shall we go for the actual break or shall we go for a prayer break and then go for the actual break later? What shall we do? Prayer break and break later also. Okay, fine. Come back at 7:30. Okay, welcome back. Shall we continue? Let's continue. Yeah. Shall we continue? Okay, let's continue. Okay, so we are done with investment appraisal. Next area which we are going to quickly go through is working capital management. So we're going to start off with looking at the introduction to working capital. Introduction to working capital. So under that, the first thing which we looked at was the definition. What is the definition of working capital? Working capital is the cash or is the money which is needed for the day-to-day operations of the business. Okay. And how do you calculate working capital? Guys, how do you calculate working capital? Make it quick. Working capital is Munada. Working capital is, yeah, inventory plus receivables minus payables, or we can say current assets minus current liabilities, or we can take it receivables plus inventory minus payables. Both are correct. Okay. The next thing which we looked at was what are the objectives of working capital? Okay. What are the objectives or what is the conflict in working capital? What is the conflict? So, what is the conflict in working capital? What is the conflict? Liquidity, correct. Liquidity versus profitability. And then finally, we looked at what are the decisions or what is the role of working capital. So, in working capital, as the finance manager, we are making two decisions. What are those two decisions? Investment decision and financing decision. So investment decision, what is investment decision? How much to invest? Sorry, how much to invest? That is your investment decision. So what are the two fact? What is the factor which is mainly affecting the investment decision? Your risk appetite, the risk appetite of the manager. So you can be an aggressive manager, you can be a conservative manager. If you're an aggressive manager, you will keep less as working capital. If you're a conservative manager, you will keep more as working capital. Okay. Next, financing decision is okay. We decided we are going to keep $100,000 as working capital. From where are we going to get that $100,000? Where are we going to get the money from? Financing decision? Okay. So you can either go for short-term finance or you can go for long-term finance. So long-term finance is less risky, more expensive. Short-term finance, more risky, but cheaper. So aggressive person will always prefer short-term. Conservative person will always prefer long-term. Okay. Next, we looked at what? Working capital ratios. Working capital ratios. So we looked at two different kinds of companies. We looked at manufacturing companies and we looked at buying and selling companies, retail companies. So under, so what are the ratios which we studied? So for buying and selling companies, you had receivable days, payable days, and inventory days. For a company which is producing and selling or manufacturing and selling, you had few extra ratios. What were those? Raw material days, work in progress days, and finished goods days. So I'm not going to go into the ratios, it's not that important. Then we looked at what the next topic was: cash operating cycle. So cash operating cycle is what? Working capital cycle is your receivable days. plus inventory days minus payable days. So what does it mean? How long the company is taking to generate cash from the point of purchasing the inventory to the point of collecting money from the receivables. What is the time period? So having a shorter cash operating cycle is always better. Short-term finance is cheaper, yeah. Short-term finance is cheaper. And next we looked at what? Something called net working capital ratio. How do you calculate the net working capital ratio? Sales revenue divided by working capital. Okay. So what is net working capital ratio measuring? Per $1 which you're investing in working capital, how many dollars of sales are you making? Okay. So having a lower amount is better. That means your company is more efficient. Under that, we looked at another small topic called over trading, or we call it undercapitalization. Okay. Under So over trading, you are not keeping enough money for the working capital purpose. So this is something wrong which you are doing. So over capitalization, what are the symptoms? Rapid increase in sales, fall in profit margins, increase in receivables and inventory, increase in payables, reduction in current ratio, increase in the operating cycle. These are symptoms of over trading. How do you manage over trading? Invest more as working capital. HLI. So when the company expands too fast without properly investing into working capital, it will lead to a situation where you are over trading. What is under trading? You are investing too much money into working capital and you are not getting the proper benefit. So these were the areas. Next, we are going to look at one other inventory management. So under inventory management, first thing, how do you do this? So under inventory management, the first big thing which we looked at was EOQ, economic order quantity. So what is EOQ? It calculates, okay, at which order quantity is it the cheapest for the company? Which order quantity is the cheapest? So there are certain costs which are associated with inventory. What are the costs associated with inventory? What are the costs, guys? What are the costs associated with inventory? There are two costs. Ordering cost and holding cost, correct. So EOQ looks at, okay, at which order quantity are you going to minimize both the holding cost and the ordering cost. So EOQ will give you the most economic, cheapest order quantity unless there are any bulk discounts. If there are bulk discounts, what should you do? You have to calculate EOQ value and you have to calculate bulk discount cost and compare the next thing, what did we look at? Before that, assumptions of EOQ. What are the assumptions of EOQ? Assuming zero lead time, assuming fluctuation, sorry, ignoring the fluctuation in the demand, assuming constant holding and ordering cost. Okay. Next thing, what did we look at? Just in time inventory system, or we call it JIT. So what is just-in-time inventory system? What is the purpose of a just-in-time inventory system? In order to try to keep inventory levels at zero, improving the efficiency, reducing the wastage, having faster production period. These are goals of a just-in-time inventory system. So in order for this just-in-time inventory system to work, there should be certain things in the organization. What is that? You should have a small number of trustworthy suppliers. Okay, small number of trustworthy suppliers. There should be less delays in production. There should be a small production run. Next, you should have a very good forecast of the demand. All of these are things which you should have in order for a JIT system to work. So, inventory management and ordering costs are same. No, you can't say that, Afra. Technically, no, it's different. Next thing which we learned was bin system. So under that there were two further types. One bin and system. So I'm not going to go into detail. That is something which is not that important. And next, finally, sorry, next I was there's two more. We looked at reorder levels and we looked at periodic review. How do you calculate the reorder level? How do you calculate reorder level? What is the formula? Okay. So next, periodic review system. What is periodic review system? At the end of each period, you will be constantly reviewing your inventory management, inventory level, inventory policy, inventory ordering system, everything. So this is inventory management. Next, we are going to look at receivables management. Management. The first thing which we are going to look at is what? Only thing we are going to look at the receivables management policy. So what is included inside the receivable management policy? Assessing the credit worthiness, first thing. Giving credit limits. Next is issuing the invoices. And then you have collecting the cash. And finally, monitoring and review. So these are the things which are included inside the receivables management policy. Next, we are going to look at different methods to manage the trade receivables. First method is what? So you have to know, okay, if all of the customers are accepting the early settlement discount, how do we, do the calculation? If half of the customers are accepting the discount, half of the customers are rejecting the discount, how should we do the calculation? Both scenarios you have to do it. You have to know it. Next thing, invoice discounting. What is invoice discounting? Invoice discounting is when the company is selling the invoices of your receivables. You are selling your receivables to someone called invoice discounter. When you are selling this to the invoice discounter will give an advance on the receivable value. So you can raise financing this way. So invoice discounting. If you go for an invoice discounting arrangement, should your customers know about this arrangement or is it confidential? What do you think? The invoice discounting arrangement which you have, is it something which the customer should know about? Or is it something which you can hide from the customers? Without the customers knowing, you can do it. Yes, it is something confidential. Hey, remember, important point. So this is one advantage compared to factoring. Factoring, what is happening? The factor, the customer will know that you are going for a factoring service, but invoice discounting happens in secret. Okay, you are hiding and doing that. Next, you have to know about another. factoring. So factoring, you have two things. With recourse, what is with recourse? What is with recourse? Yes. Customer should bear the bad debt cost. Customer should bear the bad debt risk. What is without recourse? Factor will be bearing the bad debt risk. You have to know the definitions. Okay. So if you go for a factoring agreement, what is happening? You are outsourcing your receivables management to a third party company, the factoring company. So what are the services provided by the factoring company? One is receivables management. Next thing, if you are going for a without recourse agreement, customer will give a bad debt insurance. And next, next service or the next benefit of a factoring agreement is one other factor will advance the receipts from your customer. So your receivables figure, rather than going to the bank and getting an overdraft, the factor will give you the money. These are the benefits. So in your exams, if you get a factoring questions, what you have to do? You have to compare what are the benefits which you are getting, and you have to compare what is the cost of the factoring agreement, and you have to give the decision. If you are getting a positive benefit, go for the factor. If you are getting a negative loss, you have to reject the factor. Next, advantages and disadvantages of factoring. What are the advantages? Saving in admin cost, reduction in need for management. Okay, useful for small businesses or rapidly growing businesses. Disadvantages, extremely expensive. Factoring has a very bad reputation. Customer goodwill might be lost. Once you go for the factor, sometimes getting the receivable management in house is difficult. Okay, company losing the control. These are disadvantages, advantages, disadvantages. You have to remember, you might be required to explain or justify. Final thing under receivables management, what is it? Foreign receivables. Guys, tell me, what are the methods to manage receivables? Are the methods, different methods to manage foreign receivables? Make it quick. In study, can't remember. What is it? Fast, fast. First one is what? Export customers. Next, letter of credit LP. Okay, bill of counter trade. Good. Anything else? Anything else? Forfeiting. Sorry. Export credit insurance. Good. Okay. So far, in your exam, They have not, as far as I know, it's very rare for them to test foreign receivables management. Therefore, sometimes you might be asked to explain these foreign receivables management techniques. So, around three techniques, at least minimum three techniques, you should be good with explaining. What should we do? What the hell should we do? You should be good with explaining somehow. Read the technical article, get the knowledge, be good with it. You should be able to explain. Harida. So, all of these areas could be section C, writing part, you should be able to explain. Harida, what is forfeiting? What is forfeiting? Forfeiting is what? The what you call the company will sell the foreign receivables to a someone called a forfeiter. That is what forfeiting is. Okay. Letter of credit, what is that? LC. So that's a very big explanation. What will happen? You will buyer and seller will agree on the terms. The buyer will issue the LC and it will go for the seller. Okay. So it will go for the seller's bank. So the LC is the guarantee of the payments. So once the goods are dispatched to the buyer or the customer, what will happen? The shipping documents will be sent to the purchaser's bank. The bank will give the banker's acceptance. The seller can either sell the banker's acceptance now or they can wait till the maturity date and sell it. Okay, so you have to know this entire story. What is counter trading? Without the use of foreign currency, we are exchanging goods and services. Export credit insurance is insurance for exports. Okay, what is export factoring? Factoring for exports. Very simple. Okay, you all should know this. Next part, payables management. So under payables management, there is nothing for you to know. There is nothing important. Okay, but you should know the techniques to manage payable. Same bloody formula, same formula, early settlement discount formula, and that's it for payables. Final area is cash management. So cash management, how do you manage cash? Okay, methods of cash management. First one, cash flow forecasts. So forecast can be made. It could be a cash flow budget. It could be a statement of financial position. It could be a cash flow statement. Then you have Baumol model and you have the Miller model. Okay. So Baumol model is the EOQ formula, but with a different name. So the same assumptions apply to the Baumol model. So you should remember Baumol model is used when there are constant cash flows, when the demand for cash is constant. Miller model is used when there is, fluctuating cash flows. Okay, so under the Lenovo model, you have something called the upper limit, return points, lower limit. If cash flows reaches the upper limit, sell until it reaches, sorry, buy investments or, make investments until it reaches the return point. If it reaches the lower limit, sell investments until it reaches the return point. That's what you have to remember. Okay. Next, you have to remember short term, short term cash. Rather, when there is how to factors to consider when there is short-term cash surplus. When you have a short-term cash surplus, what are the factors to consider before investing? Three factors: liquidity, then risk, and profitability. Finally, what you have to remember: treasury management. So there are two things which you have to remember. Treasury management can be centralized or can What are the disadvantages? Disadvantages. Decentralized. What are the advantages? Disadvantages. What are the advantages of centralization? Economies of scale, improved risk management, reduced borrowing cost, expertise, all of that. Disadvantages, you are fast to react, greater autonomy, more motivation. Okay. Is it tested? Less. Tested less. It's very rare for it to be tested. So this is working capital. So you can quickly look at it. Again, 25% of your syllabus, and this is what? 50% of your syllabus. Okay, within one page. Within one page. 50% of your FM syllabus. Any questions from the working capital area? Is everything clear? Can I have a yes from everyone before moving on? All clear. So we'll do one more area and go for a quick break. Okay. We'll do business finance and go for a break. Okay. Oh, business finance. First, we looked at the introduction to business finance. Introduction to business finance. So initially we looked at short-term debt finance. Short-term debt finance. Different ways to obtain short-term debt finance. So we looked at bank overdraft, short-term loan, short-term lease, and trade credit. Next, we looked at long-term debt finance. So examples for those: bank loan, long-term lease, loan notes, bonds or debentures. So how many types of loan notes, bonds and debentures do we have? Three types: redeemable, irredeemable, convertible. Redeemable is divided into three further categories: normal redeemable, zero coupon, deep discounts. You should know the definitions of everything. Next, what you have after long term, we look at equity finance. So under equity finance, what did we learn? We learned about IPOs, initial public offering. We learned about public issue. We learned about tenders. We learned about rights issue. We learned about preference issue. Okay. So what is the rights issue? When the company issues shares for the first time. What is a public issue? When a public limited company is issuing shares to the public. What is private placing? When you are going and selling the shares to a select group of investors without giving them to the public. What is tender? Tender is where the shareholders are deciding the price of a share. What is rights issue? Giving shares as a discounted price to existing shareholders. Okay. Next, you have to preference shares. So preference shares, you have two types: redeemable, irredeemable. But here we are talking about just irredeemable. So two types are there: cumulative and non-cumulative preference shares. So you have to know the advantages of preference shares and disadvantages. What are the advantages? More flexible than debt finance and no dilution of control. What are the disadvantages? No tax relief on dividend payment and extra risk for ordinary shareholders. Okay. Next, you have to uh, consider next thing, which is what are the factors to consider when choosing between sources of equity. First one, accessibility of finance. Are we able to go for that financing source? For example, private limited company can't go for a public issue. Next, amount of finance. If it's a small amount of money, you can go for a rights issue. The cost of the issue procedure, going for IPO is very expensive. The pricing of the issue, and you have to consider the control aspect. Is the dilution being if the control being diluted? Sorry. Okay, these are the factors to consider when choosing between sources sources of equity finance. So you have to remember this. You might have to explain. Yes, Lahna? Yeah, tax relief part in preference shares. What about it? I mentioned, no? So I said that the dividend payment will not get the tax relief. So I said. Okay. Next, we are going to look at internally generated finance. Internally generated finance. So, what are the examples for internally generated finance? You have retained earnings, accumulated profits of the company. You have scrip dividends. You can give the shareholders, but you can give them instead of giving them shares. Sorry, instead of giving them cash dividend, you can give them shares. Next, what? Working capital management. Then you can say bonus issue, or you can say stock splits. So bonus issue and stock splits will not directly generate any finance, but they will indirectly raise finance. How do bonus issues and stock splits indirectly raise finance, guys? What is the answer? How do bonus issues and stock splits indirectly raise finance for the company? How do they do it? Everyone, give me 1 minute, guys. I'll be back with some water. Yes. So no, wrong answer, Hannah. How do bonus issues and stock splits raise finance? They make the shares more marketable. Correct. Rosara and Aveen, correct. They increase the marketability of the shares. What is the next thing? Internally generated finance. Next thing. What is the next one? What is the next one, guys? Internally generated finance. What am I missing? What am I missing? Yes, the dividend policy. Changing the dividend policy. Changing the dividend policy. So under changing the dividend policy, few other extra factors to consider. What are they? The first one is working capital management. I wrote it, Ryan. Factors to consider. What are the factors to consider when changing the dividend policy? What are the two main factors, guys? Two main factors to consider when changing the dividend policy? Yes. The client key effect and the signaling effect. What do you mean by client key effect? You should consider what type of shareholders do you have? Okay, do you have long-term shareholders? Do you have short-term? Before changing it, you have to consider that. What is signaling effect? By changing the dividend policy, what is the signal you will give to the market? These are the two main ones, two major ones. Along with that, what are the other factors to consider? You have to consider the liquidity of the company. You have to consider any debt governance. You have to consider what are the laws or regulations or legal factors which are there in the country. Okay. Along with that, you have to consider so different factors are there. Those you have to remember. Okay. So Ahna, what is TERP and VOFR? That is not relevant to dividend policy, no? Okay. So next you have to remember the different types of dividend policy. So what are the types? Constant payout. Paying a constant payout ratio. Paying a fixed ratio. What is stable growth? Dividends are growing at a stable rate. What is residual policy? You are making all of the positive NPV projects investment, and if anything is remaining, you are giving that as dividend. Okay, next you have zero dividend policy. You are not giving any dividends to the shareholders. You are investing all of the money and you are telling the shareholders, shareholder, if you want a dividend, you manufacture your dividend, you go sell your share, get the dividend. If you want, sell the share, get the dividend. Share. Next is constant payout. Constant payout is different from constant payout ratio. What is constant payout? Fixed payment of shares. Sorry, fixed payment of dividend. These are the different dividend policies. Okay. So generally, a young company will follow a residual policy and a mature company will follow a stable growth or a constant payout policy. Next thing which you have to know is the monada dividend irrelevancy theory. So Modigliani and Miller's dividend irrelevancy theory. So what does this say? Dividend irrelevancy theory is saying that monada in a perfect capital market, what will happen? Shareholders will not care whether they are getting a dividend or not. So you can do whatever you want. Dividend is irrelevant. Dividend does not matter. So you have to remember what are the assumptions in this policy. No tax, no personal income tax, perfect capital market, no transaction cost. These are the assumptions. Next, what is the next thing? Islamic finance. So under Islamic finance, we learned a couple of things. Monada, yes. Murabaha, Mudaraba, Musharaka, Ijara, and Swap. Good, correct. So what is Mudaraba? Sorry, we'll start off with Murabaha. What is Murabaha? Murabaha means credit sale, cost plus profit. What is Mudaraba? Partnership. One party capital, one party skill. The capital provider will bear all of the losses. Profits will be shared based on a pre-agreed ratio. What is Musharaka? Musharaka is what? Joint venture, both party capital, both party skill. Profit is shared based on a pre-agreed ratio. Losses are shared based on the capital provided. Next, Ijara, Islamic leasing. Sukuk, Islamic bonds. Should you know all of this? Yes, you should know all of this. If you get a business finance question, sometimes you will be asked to explain these stuff. Okay. So simple, guys. It's very simple, very small. For example, if they ask you to explain Mudaraba, simply 3 points you have to explain. You have to say it's a partnership where one party provides capital, one party will provide scale. Profits will be shared based on what? A pre-agreed ratio, but loss is fully borne by the investor. These points, if you mention full 2 marks, they will just give you, keep these 2 marks with you. Here, go. It's very simple, guys. Just these points you have to remember. Okay. Sukuk is Islamic lease. Okay, briefly explain the sense. Sukuk is based on a underlying tangible asset. So what will happen? There is a Sukuk manager and there are Sukuk holders. Along with that, there is you who is raising the money. So what will you do? You will appoint someone called the Sukuk manager. Sukuk manager will find people to invest in your whatever the project and they will sell the Sukuk bonds to those investors. So those investors will become Sukuk holders. The Sukuk holders will have the right over the cash flows generated by your project. So they will get the returns from the project until their capital is covered. Okay. Ownership is not transferred. Okay, Ayman and Amna, clear? Sukuk. Alright. Moving on to the main area. Cost of capital. Cost of capital calculation. So cost of capital calculation, what do you have? We are starting with cost of equity. Then you have cost of reference shares. Then you have final one, cost of equity. Okay. So cost of equity. Cost of equity. Cost of equity can be calculated. Guys, quickly tell me what are the two methods? What are the two methods? Dividend valuation model and the CAPM model, capital asset pricing model. So dividend valuation model, what is the formula? KE equals D0 into 1 plus divided by, that. This is the dividend valuation model. So there are certain adjustments which you have to remember in the dividend valuation model. Okay. First adjustment is what you have to remember. Why are we doing this D0 into 1 plus T, guys? Why are we doing this D0 into 1 plus T for what? Why? To get the D1, year 1 dividend. So what happens is, if the question is giving the year 1 dividend, certain students will go and do the calculation. They will take D1 as D0 and do the calculation. Remember the logic, okay? We are doing this D0 into 1 plus T to get the D1, year 1 dividend, not today's dividend. We don't want today's hang on there. We want next year's dividend. That's why we are doing this adjustment. So you have to remember that adjustment. Always we are trying to calculate year 1 dividend, not the today's dividend, next year's dividend. Next adjustment is the market value adjustment. What market value should we use, guys? What market value? Yes, X, right, market value. The market value excluding the dividend. Next, so growth rate can be calculated in two ways. What are the two ways? Old method, new method. What the hell is that old method? New method. What's that? You can calculate growth in two ways. What are those two ways? Yes. Raya, formal model is in cash management, man. See something else. Guys, don't give me stupid answers. You're like, okay, formal model is in cash management. We discussed that already. This is something different. Yes. You can calculate growth in. So historic growth model is based on historic growth. You are going to use the present value formula, rearrange the formula and calculate the Gordon's growth model. What is the formula? G equals E uh, re, the retention rate into the monada accounting rate of return or ROI. Okay, so these are the adjustments. Next, you have to remember what are the assumptions in the dividend valuation model. We are assuming constant dividend. We are assuming dividends are paid till perpetuity. We are assuming constant dividend or constantly growing dividends. Okay, and we are considering whatever the dividend is a proper indicator about the value of the company. These are the assumptions you have to remember. Keep it in your head. Next, CAPM model. What is the formula for the CAPM model? K equals risk-free rate risk-free rate plus beta into market rate minus risk premium. Risk-free rate. Okay. So capital asset pricing model. So under CAPM, you have to remember couple of stuff. What do you have to remember? Systematic risk and unsystematic risk. You have to remember an investor faces two types of risk. How many types? Two types. Systematic, unsystematic. Which risk can be diversified? Systematic or unsystematic, guys, make it quick. Which risk can you diversify away? Which can you diversify? Systematic or unsystematic? Unsystematic risk. So systematic risk is the risk which everyone is facing. Economic problems, COVID-19, systematic. Unsystematic risk is the industry specific risk which can be diversified away. So how can you diversify unsystematic risk? By diversifying your portfolio. What do you call that theory? Portfolio theory. Okay. So certain things are there in beta which you have to understand the beta, all of that. Along with that, you have the advantages and disadvantages of CAPM. What is the advantage? CAPM is connecting the risk and return. Okay, CAPM is showing the impact of systematic risk on the return. Okay, CAPM is the best method for estimating a quoted company's cost of capital. Disadvantages, unsystematic risk is ignored. Okay, so we are considering the level of return only and not the way in which shareholders are getting the return. It is a one period model and it can't be used for an unquoted company. These are the disadvantages. That's it for the CAPM method. Next, cost of preference shares. How do you calculate cost of preference shares? Preference share dividends divided by the market value. Simple as that. Next, cost of debt. What do you have? Different kinds of debt, actually, a lot. You have here redeemable debt. You have redeemable debt. You have and you have normal annuals. So irredeemable debt, how do you calculate interest over market value? Is this correct, guys? Is this correct? Is this correct? Interest over market value, Haridha? Ah, no. You have to adjust for the tax saving. Okay. Interest into 1 minus T. Very good. You are the third. Redeemable debt. How do you calculate? IR. IR. Normal. Normal bank loan. Interest into 1 minus T. So once you calculate all of these different costs, you will calculate the weighted average cost of capital. So weighted average cost of capital can be calculated based on monada, it can be calculated based on market values, or it can be calculated based on book values. Next thing, when can we use the existing WACC investment appraisal? So under two situations, you can use the company's existing weighted average cost of capital for investment appraisal. You don't have to recalculate it. So what are those two situations, guys? I'll give you all some time to quickly write those two situations. Sarah, please clarify what risk. Others, make it quick. First situation, if the then you get the same cost of capital. Second situation, if the capital structure is, then you can use the same. Then I can ask this question the other way around. If in which two situations should you recalculate the WACC? If the business risk is changing, if the capital structure is changing. Next one. We are going to look at what? Second point is if the gearing is not changing, if the capital structure is not changing. Next, we are going to look at the capital structure theories. We are going to look at the capital structure theories. Starting off with the first theory, traditional theory. So what is the traditional theory saying? Traditional theory is saying what? As the as the gearing increases, your WACC will reduce. After a certain point, it will start increasing again. So the point where the WACC is the lowest is known as the optimum point. Where the WACC is the lowest, that is the optimum capital structure. Okay, so why is it reducing? Because as your gearing is increasing, company is benefiting from the cheaper debt. That's why it's reducing. And again, it will start increasing. Why? Because as the gearing is increasing, cost of equity will also increase. So the increase in cost of equity is greater than the savings from the debt. That's why it's going back up. So there is an optimum point. So what, according to the traditional theory, what should the company do? We should identify this optimum point and try to maintain our capital structure at the optimum point. Next, theory 1, without tax. So theory 1, without tax, what did they say? You can do whatever you want. Whether you go for equity, whether you go for debt, capital, your WACC will remain the same. So go for equity, go for debt, does not matter. Next, theory 2, with tax. What did they say? theory 2 is telling what? Go for debt. Always go for debt. As you keep on taking more and more debt, what will happen? WACC will keep on reducing. So they will say always increase your gearing. Keep on taking more and more debt. That is theory 2. So you have to remember Modigliani and Miller, both the theories, you have certain assumptions. What are those assumptions? Perfect capital market, rational investors, no transaction costs. Okay, all of that. Traditional, yes, in traditional theory, we are taking into account the tax benefit. That's why you are getting the optimum point because of the lower cost of debt. That means both the cheaper cost and the tax benefit is contributing to the reduction in the back. Next theory is the pecking order theory. Guys, tell me, pecking order theory is based on what? Pecking order theory is based on what? What is pecking order theory based on? Pecking order theory is trying to minimize what? Where are the at least one person should get the give the correct answer. Pecking order theory is based on something. Ah, correct, Yusuf. Correct. I mentioned this in the class also. Pecking order theory is based on transaction cost. It is seeking to minimize the transaction cost. So they are ranked the causes of finance based on the transaction cost. Lowest transaction cost to higher transaction cost. So if you remember that, you don't need to memorize. What is having lowest transaction cost? Internally generated finance. Next one, debt finance. Next one, rights issue. Okay, so you have to remember this. Okay, so according to pecking order theory, if you want money first, you will go for internet generated. Next, you will go for debt. Next, you will go for convertible debt. Next, you will go for preference shares. Next, and finally, the final option, you will issue new shares. Okay, so it is based on the transaction cost. Next thing, what did we look at? We looked at re-gearing and okay. So under is my screen visible? Disappeared. Is it visible, right? Yeah. Under re-gearing and ungearing, what do you have to remember? The different steps. Okay, so I'm not going to give explanation. Okay, re-gearing, ungearing, when is it happening? When our company is going into a new industry. Therefore, we have to recalculate the cost of equity. Why? Because business risk is changing. How do we recalculate? What are the steps? Step two. What is step two? Ungear proxy companies. Equity beta. What will you get? What will you get? You will get the asset beta. What does the asset beta represent? What does asset beta represent, guys? Asset beta is representing purely the business. Final step, step re-gear the proxies asset beta with our company's capital structure. Simple three steps, guys. You don't need to overcomplicate. Only three things. You do three things. That was the first thing. Examination will do it. First thing, examiner do it. Examiner will give you proxy company. Only two steps is there. Very simple. Okay. So if you re-get it, what are you getting? You will get equity beta. Equity beta is what? Our company's risk in the new industry. Okay. So equity beta, sorry, asset beta will include both the business risk and the financial risk. Okay. Next. Next, we looked at the monada financial ratios. Okay, we looked at the financial ratios. financial ratios. So I'm not going to go into it because very simple stuff, but just remember there were financial ratios also. So I'll just, repeat the ratios which you have, which we studied. Okay. We looked at interest cover, interest yield, dividend per share, dividend cover, dividend yield, EPS, PE ratio. These were the ratios which we studied. And then next, we learned something called operating gearing. Operating gearing. So what is operating gearing? What does operating gearing measure? What does operating gearing measure? What does operating gearing measure? What does it measure? Not really. What does operating gearing measure? Yes. The proportion of fixed cost to variable cost, or we can say what is the business risk. Okay. So how do you calculate the operating gearing? How do you calculate the operating gearing? What is the formula? Fixed cost over total cost, or you can take it as contribution over PBIT. Next, business finance for SMEs, small and medium-sized entities. Okay, so business finance for SMEs. What are the different sources of finance? Okay, business angels are wealthy individuals which will provide capital. Then you have how the venture capital is. What are the others? Correct? Peer-to-peer funding, good. Okay, crowdfunding, good. Anything else? Supply chain financing. Uh, One more thing I mentioned in the class, which is not there in the tube. One more thing I mentioned in the class, but it's not there in the tube. What is that? Correct. Very good, Anya. What is that? Private equity. Private equity. Okay. Next, you have to remember the funding gap and maturity gap in SME. So, what is funding gap? The difference between the amount which we want and amount which we received. What is maturity gap? The mismatch between the maturity of assets and liabilities in the company. That's it for business finance. So 75% of the syllabus is covered, guys. How simple. Very easy, no? Any difficulty over here? Any difficulty? FM exam and all very simple stuff. Okay. So this is 75% of your syllabus. Only this much, man. Okay, you all can take a screenshot if you want. Okay. Any questions, guys, from business finance area? Any questions? Or is everything clear? All good so far? Can I have a yes? Okay, let's continue. Okay. So what is the next area? The next area is business valuations. Okay, business valuations. Okay. So initially, what did we look at? We looked at the different methods of valuation. The methods of valuation. So how many different methods of valuation do we have? First method is asset-based valuation. Next, you have income-based valuation. Finally, you have cash flow-based valuation. Okay. So asset-based valuations, what is it based on? Based on the value of the assets which the company has. So under asset-based valuations, you have a further few more types. What is the first one? Net. Next, you have net realizable value. And then you have replacement. So net book value is the book value of assets minus book value of liabilities. NRV is market value of total assets minus market value of total liabilities, also known as asset stripping. Replacement cost is the cost of the assets if you are buying the same type of assets which the business has on the open market. So you have to know what are the advantages of, sorry, what are the disadvantages of an asset-based approach. Guys, tell me some disadvantage of asset-based approach. Disadvantages, please. Disadvantages. Okay. Main disadvantages. Anything else? Yes. Limited usage in service industries. We are ignoring the value of certain intangible assets. We are ignoring future profits, future income, and future cash flows. These are the main disadvantages. Next, income-based methods. You have a what is the first one? PE ratio method. Next, you have earnings yield method. Anything else? Dividend yield method. Next, you have cash flow based valuation. So for equity, you have a different method. For debt and preference shares. So the valuation of equity, what do? You are going to be using the dividend and debt. What is it? Present value of the cash inflows, NPV. Preference shares, same thing. Present value of the inflows, you are going to calculate. Simple as that. Next thing which we looked at was something called mergers and acquisition. M&A. Mergers and acquisition. What is the definition of mergers and acquisition? The differences, types, and we talked about how to make decisions regarding mergers and acquisitions. Next, what did we look at? We looked at the efficient market hypothesis. So there are three different types of markets: weak form, strong form efficient, and strong form efficient. A weak form efficient market includes only the information and public information. So in a weak form market, you can make abnormal gains using what? You can make abnormal gains using public information. So in a semi-strong form efficient market, you can make abnormal gains using insider information. In a strong form efficient market, you cannot make abnormal gains. And the next final area which we looked at over here was behavioral finance. So this was the only things which we looked at. Correct? Anything which I am missing? Anything which I have forgotten? No, right? I don't think I have missed anything. So only that. Okay, so very small area, business valuations. Next area, what is it? Risk management. So under risk management, we learned that there are two main types of risks. What are the two main types of risk? You have foreign exchange risk and you have interest rate risk. So we looked at initially we looked at foreign exchange risk. Okay. So there are three types of foreign exchange risk. What are those three types of foreign exchange risk? Three types of foreign exchange risk. What are those three types? Yes. Correct. Others, three types of foreign exchange: transaction risk, translation risk, and economic risk. Transaction risk is due to each transaction which you are making. What is the risk? Translation risk is when you are converting balance sheet figures. Economic risk is the due to the economic factors which are existing. You can forecast the exchange rate using two methods, guys. You can forecast the exchange rate using two methods. What are those two methods? Yes. Interest rate parity and purchasing power parity. Now we are going to look at different methods or different ways to manage this foreign exchange risk. So first one is what? Invoicing in home currency. Next one you have leading and lagging. So what is invoicing in home currency? You are only sending the invoice in home currency. Then no problem, no need to convert. What is leading and lagging? Leading is when you are doing the future transaction today. Lagging is when you are postponing the transaction. What is the next one? Netting. Then you have matching. So netting, what do you do? Netting is when you are setting off supplier and receivable balances, payable and receivable balances between the same company. Matching is you are setting off the balances with two different companies, between two different companies. Next, you have asset and liability management. All of these are internal methods. Following this, you have certain further methods: forward contracts. So forward contracts, what are they? They are agreements which you are making with the bank, which is creating an obligation for you to convert foreign currency at a future date at a fixed price. Forward contract. Next, you have money market hedging. So you have to remember the numbers, okay, for money market hedging, the steps. For receipts is different, for payments is different. Money market hedging for receipts, what are the steps? Let me write it here. Money market hedge, receipt. Can you all tell me what is step one? Ah, take a loan in foreign currency. Step two, ah, convert to home currency. Step three, deposit in home country or currency. Simple. Okay. So money market hedge payments. Let's look at the step. Steps. Step one, money market hedge payments. Step one. Receipts, you all were very fast giving the answer. Payment only little bit you all are lost. Deposit in foreign currency. Step two, convert the deposit to home currency. Step three, take a loan in home currency. So money market hedge payment steps are working in one direction, but realistically, how it is happening from step three to step one, only realistically the steps are happening. So first you will take a loan, convert it, then only you will deposit. But the steps calculation you have to do in the opposite direction. Remember? Yes. Next, you have currency futures. So you have to remember what are the differences between currency futures and forward contracts. Guys, tell me differences between currency futures and forward contracts. What are the differences? Okay. So, okay. So they you are giving differences, but not everything is a difference. Okay. Futures are standardized contracts, have fixed delivery dates. Okay. Can be traded. These are the main differences, Harida. Okay. So next, what is the next thing? That's it. No options are there. Options and currency swaps. The options and you have currency swaps. So options are what? Options give you the right, but not the obligation to convert the currency. If you are going for the option rate, it is called as exercising the option. If you are ignoring the option rate, it is known as lapsing the option. So these are what you have to remember. Okay. Next, you have interest rate risk, different methods of managing interest rate risk. You have agreements, you have have futures, you have smoothing, you have matching. What else do you have? Cap, flow, and collar. Anything else? Am I missing something? And interest rate swaps. Asset and liability management. ALM. Asset and liability management. So, what is forward rate agreement? It is similar to what? Same thing as one other. The foreign exchange forward rate agreement. Same thing. It's no huge difference. Okay, same thing. Okay, guys, give me 1 minute. Okay. Guys, give me 1 minute. Okay. Okay. Sorry. So forward rate agreement, what is it? It is an agreement obligation with the bank to either borrow money at a future date or deposit money at a future date. Okay. Asset and liability management, what is that? You are going to match your assets and liabilities. What are options? Interest rate options are giving you the option basically. Either you can go for the options interest rate or you can go for the actual interest rate. So if you are going for the option, it is called exercising the option. If you are going for the spot rate, it is called the lapsing the option. Futures, pretty much the same thing. Okay, smoothing, what is it? Matching all of these very simple stuff. Cap is what? Cap is maximum, minimum. Collar is you are getting both cap and flow. Yes, options you are getting the right to sell, buy or sell futures. So you have to remember under interest rate options, a person who is going to borrow money, what will he do? Will he do buy now, sell later, or sell now, buy later? If you are going to borrow money, if you are using futures, what will you do? Buy now, sell later, or sell now, buy later? You will do a sell now, buy later. Hey, mother. You will do a buy now, sell later. You will do a buy now, sell later. Okay. If you are going to deposit money, you'll do a sell now, buy later. Remember that. So Is that it for interest rate management? That is it for interest rate management. So section A, B, financial management function, financial management environment. I'm not going to go through it. Why? It's a very simple area. So you don't need to waste time over there. So this is 98% of your FM syllabus is mostly covered over. Here I tried my best. Okay. So maximum I try to summarize it. So yeah. Any questions, guys? Financial management function environment, I'm not going to touch it because I don't feel like it's pointless. 2% only that you all can do on your own. Everything I don't have to spoon feed, but 98% I have done the revision. Okay. So, guys, any questions? Any questions? Yes, Sahnaf. You all can ask any question, any doubt which you have, you can ask. Leading and lagging. Leading and lagging. I mean, leading means what? A future transaction you are doing today. Why? Because today's exchange rate is favorable. Lagging is what you are postponing the transaction. Okay, Ayman. Can we go to profit from net cash flows by deducting? You you can't get operating profit. Hanaf, if you want the operating profit, you can't do that. Okay, Hanaf. Any other questions? Guys, any other questions or everything is clear? Any doubts which you all have? Any problems, any issues? The FM syllabus need to clarify? So I will give you all the opportunity to unmute and speak also. If you want, you all can unmute. You want, you can unmute. Yes. Yusuf, we are using the net cash flows for the payback calculation. Yes. Dividend yield. You mean the ratio? Dividend yield ratio. So explanation means the return. I mean, as a percentage of the market price, what is the dividend? That's what it means. ROCE from NPV calculation, is it sales minus? Yusuf, you're asking the operating profit figure, right? So you will take the operating cash flows, the figure which you are using for the tax calculation. From that, you will deduct the depreciation. Sales minus variable cost minus fixed cost minus depreciation. Okay. Anything else? Any other doubts? Syllabus wise, you all are 100% clear, guys. Why buy now, sell later for borrowing? Afra, a person who is going to borrow money, what is the fear which you are having? If you are going to borrow money, Afra, what is the fear? Your fear. You're scared that interest rate will reduce or interest rate will increase. Interest rate will increase. So let's say now current interest rate is 10%. You are afraid it will go to 15%. Okay. So if the interest rate is 10%, Afra, what will be the future price? Not the price in the future, the future instrument price. What will be the price of the future? No, if the interest rate is 10%, what is the price of the future? How do you calculate price of a future under interest rate? Okay, answer this question. Okay, so how do you calculate the price of the future under interest rate risk management? 100 minus interest rate. Price of the future is 100 minus interest rate. Is this clear? Okay. So what is the price of the future then? 90. What will be the price of the future after 3 months if the interest rate increases to 15%? 85. Right now, future price is 90. After 3 months, future price will be 85. If you want to make a gain over here, if you want to get a positive figure over here, what should you do, Afra? Should it be positive and then negative or negative and then positive? Positive, then negative. What does that mean? Sell now, buy later. Okay. Okay. So for G equals BR, we are considering only return on equity, but not the ROCE. It's better to take the return on equity, better to take the return on equity, but if you are unable to calculate it, you can take the ROCE. Okay. I mean, right. So guys, syllabus wise, everything is clear. Can I have a yes from everyone? Yes, all good. Fine. So now exactly 7 days remaining. We can't say 7 days for the exam. It's technically just 6 days. So guys, in these last 6 days, okay, so just focus on the revision, focus on reading the technical articles, focus on mock exams. Okay, don't focus on trying to study new topics, whatever. Don't get too much stressed. FMA is a very simple exam, guys. Don't get too much stressed. So one day before the exam, which is Wednesday, don't study anything. Don't do anything on Wednesday, guys. Make sure Wednesday is a rest day before the exam. Okay, so keep that day free before the exam. Don't panic. Don't study too much. Have a good night rest. Okay, sleep for at least 8 hours. Maybe if you want 12 hours, also sleep for 12 hours and go for the exam. Okay, so remember, not only having the knowledge in your head, mindset is also very important. So make sure that you are not panicking. You are having a very good attitude, positive, optimistic attitude. Okay, you should think and go. You should not think FM exam will be difficult. What is your mindset? FM exam is a piece of cake. I'm going to go inside the exam hall. I'm going to do the exam in such a way that I will score 90 marks. That should be your mindset, guys. Okay. So during the exam, make sure time management wise, what should you all do? Don't waste time on questions. You have only 3 hours. So please make sure that you are allocating the time properly. So before going into the exam, have a proper game plan. Have a proper game plan. I'm going to spend this amount of time section A, this amount of time section B, this amount of time section C. So once you have that game plan, let's say you have allocated 1.5 hours section A and B. So once the 1.5 hour is up, if you have not attempted questions in section A and B, what should you do? Leave section A and B, go to section C. So always follow that plan. Okay. So also one more thing in the exam, always keep an eye on the timer. Okay. So for especially for section C, you can maximum spend maybe 25 minutes on one question. So if it's passing 25 minutes, just leave that question, guys. So don't spend too much time on one question. Okay. So if you don't know a question, if you can't attempt it, if you know for sure, even if I spend 10 minutes on this question, I won't get an answer, don't do it. Always in the exam, try to quickly in the first hour, try to get the maximum amount of marks possible. Do all of the easy questions. So in the first hour, if you can at least score 30 marks from the easy questions, the balance 2 hours, you can score the remaining marks easily. Okay. So yeah. So one more thing in the exam, when you look at questions which are difficult, let's say for example, you started the exam, first question, very difficult risk management question. You don't know what the hell that question is. You can't understand what they're saying also. So there's a question like that, simply leave that question. It's okay. So have that proper exam technique in mind. So leave that question. It's just 2 marks. You still have 98 marks remaining. Don't get panicked. So that is very important. So many students, they always get panicked in the exam. They get scared. They get nervous. They get anxious. So don't be like that. Have that mindset. FM exam is easy. Okay. And go do the exam and pass with, flying colors. Okay. So I need all of you all to pass. Obviously, not only pass, I need all of you all to score very well. 70s, 80s, 90s, 100s also, no problem. If you're scoring 100, I'll be very happy. Okay. So, yeah. So, guys, yeah, that's it. We are done. 100% from my side. I have given my best. Okay, for you all. So, maximum I have given my best. So, rest is, on your hands, in your hands, how you all have studied, how you all have worked hard. Remember, the result which you are getting is a reflection of the work which you put in. Okay. It's not really my work. I can't say, okay, if a student passes, I can say, okay, student passed because of me. Okay, so if you have scored 90s, 80s, 70s, that is actually your hard work. Okay, so yes, so do your best, guys. Don't get too disappointed if you only score very low. Okay, so yeah, yes. So yeah, we are done. 100% if all the classes are done. So I have been seeing your faces for 6 months. I'm also fed up. Maybe you're also fed up of my face. Yeah, it happens. Okay. Yes. So yeah. So yeah, bye bye guys. Best of luck for your exams. And once you all get the results, please let me know the results also. Okay, best of luck. Do your best, guys. You're welcome. Yeah, you can take a screenshot also if you want. No worries. You're welcome. You're welcome, Ahnaf. Yes, I will.